Good afternoon. I'm Tom Curry, another partner, and I co-chair our banking practice group. I want to thank you for joining our webinar. This afternoon, we will explore the features of the Federal Reserve's revised Main Street Lending Program. Our panel of Nutter experts will discuss the Main Street Lending Program's evolution, its current terms, and share some of the key considerations and unresolved issues facing borrowers and lenders. I'm pleased to be joined by my colleagues Matthew Doring and Ellie Myers from Nutter's Commercial and Real Estate Finance Group, and Megan Kelly and Joshua Gray from Nutter's Corporate and Transactions Group on today's webinar panel. Megan will give an overview of the Main Street Lending Program's revised terms and interpretive FAQs. Josh will follow up by giving the borrower's perspective, and Ellie will share the lender's perspective, and Matt will wrap up discussing some unresolved considerations. Let me begin by tracing the evolution of the Main Street Lending Program. The Main Street Lending Program is an integral part of the CARES Act's extraordinary fiscal support of small to mid-sized businesses, many of which are adversely impacted by the coronavirus pandemic. It combines direct financial support from the U.S. Treasury's Economic Stabilization Fund with the leveraging permitted under the Federal Reserve's Emergency Lending Authority. The scale and breadth of the Federal Reserve's use of its emergency lending authorities, including its support of commercial lending, is unprecedented. Title IV of the CARES Act expressly permits the Federal Reserve to establish this lending program or other similar program or facilities under its emergency lending powers that supports lending to small and mid-sized businesses, including any entity which the Treasury's mid-sized business program makes a loan guarantee, or other investment. Instead of direct loans to small to mid-sized businesses, Treasury opted to provide a loss-absorbing equity backstop to leverage the Federal Reserve's program and for ease of administration. The Federal Reserve has extensive experience in this area. It has swiftly revived a number of emergency credit and liquidity facilities from the last crisis and launched new ones like the Main Street Lending Program to handle the current coronavirus-induced economic downturn. Interestingly, the Federal Reserve announced its intent to establish a Main Street Lending Program facility on March 23rd, well before the CARES Act's actual enactment into law. This was a clear signal that it intended to support this key sector of the U.S. economy. On April 9th, the Federal Reserve followed up with a formal launch of the new Main Street Lending Program under its Section 13.3 Emergency Lending Authority. The Main Street Lending Program leverages $75 billion in U.S. Treasury equity funding derived from the CARES Act, and it allows the Main Street Lending Program and its special purpose vehicle to purchase up to $600 billion in loans to eligible small and mid-sized businesses that were in good financial standing prior to the COVID-19 crisis. By comparison, or point of reference, the TARP authorization in the global financial crisis amounted to approximately $700 billion in funding. The Federal Reserve's rollout of the Main Street Lending Program hopes to avoid many of the pitfalls associated with the hastily launched Paycheck Protection Program, or PPP, by seeking stakeholder feedback on the proposed Main Street Lending Program and of its initial proposed terms and conditions. On April 30th, after receiving public feedback on potential refinements, the Federal Reserve Board announced an expansion of the scope, terms, and eligibility for the Main Street Lending Program that we'll talk about in detail today. The actual launch of the Main Street Lending Program, however, has yet to be determined. I'll now turn it over to Megan Kelly, who will give an overview of the Main Street Lending Program's key terms and conditions. Megan?
Thanks, Tom. Hi, everyone. Thank you for joining us today. My name is Megan Kelly, and I am a part of Nutter's Corporate and Transaction Group. As Tom said, I'm going to give a brief high-level overview of the Main Street Lending Program and the basic terms of these loans, before we get into the specific considerations that borrowers and lenders should think about in connection with each of these facilities. So this program has been designed to provide relief to small and medium-sized businesses that were doing well before this pandemic hit. This is a good option for those businesses who may not have been able to get a PPP loan or need some additional relief in addition to a PPP loan that they've already received. So this program will operate through 3 different facilities: the Main Street New Loan Facility, the Expanded Loan Facility, and the Priority Loan Facility. These were each designed with different needs in mind and have different terms which will govern which loan may work best for each borrower. For each of these facilities, the Federal Reserve Bank of Boston will set up a special purpose vehicle that will purchase a portion of these loans, which will be originated by eligible lenders, the details of which Ellie is going to expand upon in her discussion of considerations that lenders should think about. Both of the new and the priority loan facilities are new loans that are entered into after April 24th, 2020. For the expanded loan facility, these would be existing loans that were already in place before April 24th and that can now be expanded through an additional tranche. There are some terms of these loans that will be the same for each of these 3 facilities. Any of these 3 loans can be secured or unsecured. They each will have a 4-year maturity, an interest rate of LIBOR plus 300 basis points, and can be prepaid at any time without penalty. The other terms related to these loans will differ depending on which facility you go with. The new and priority facilities now have a minimum size of $500,000, which was a change from the original term sheet, and the expanded loan facility now has a minimum size of $10 million. The maximum loan size is largely a function of EBITDA, which my colleague Josh Gray will expand upon. But at a basic level, the new loan facility has a maximum size that is the lesser of $25 million, or an amount when it's added to the borrower's existing outstanding and undrawn available debt doesn't exceed 4 times adjusted 2019 EBITDA. And it's similar for the priority loan. It's once again the lesser of $25 million or 6 times adjusted 2019 EBITDA. And for the expanded line, it is the lesser of $200 million, 35% of the borrower's existing available debt, or 6 times the adjusted 2019 EBITDA. So these EBITDA requirements will have implications for who will be able to make use of these facilities, which is something that my colleague Josh Gray will get into. For each of these loans, all of the principal and interest will be deferred for 1 year. For the new loans facility, this will be then paid back in equal installments over years 2 to 4 of 1/3 each. For the priority and expanded loan facilities, this will be paid back in installments that start at 15% for years 2 and 3, and then jumps up to 70% to be paid back in year 4. So that's something to think about in terms of the schedule for repayment and how aggressive you want to be with your repayment of these loans. In terms of how these loans will be treated in relation to other debt, the new loan facility cannot be contractually subordinated in terms of priority, and it must be junior to the borrower's other unsecured loans and debt instruments. For the priority and expanded loan facility, these must be either senior or pari passu in terms of priority and security with all other loans and debt, except for mortgage debt. So for borrowers, this will be important to think about how these loans will work in relation to the other debt instruments you have in place currently and which facility will work best for you. In order to apply for one of these loans, the first step is just to get in contact with an eligible lender. They'll be able to provide you with applications, and they may have other additional requirements that need to be met for that specific lender, which is something that my colleague Ellie will discuss further. I'm now going to turn this over to Josh Gray, who's going to talk about some of the specific things that borrowers should be thinking about when looking at one of these loans and what will work for them.
Thanks, Megan. This is Josh Gray. I'm a partner in Nutter's Corporate and Transactions Department. And I'll be talking about factors that prospective borrowers should consider in deciding whether to pursue loans under one of the Main Street lending programs. The first thing to consider is whether a particular business is even eligible to participate. In order to be eligible, the business has to have been in existence prior to March 13th of this year, organized as a for-profit entity, although the most recently distributed FAQs from the Fed have left open the idea that a not-for-profit could apply at the Fed's discretion. The borrower must have less than 15,000 employees or have 2009 annual revenues less than or equal to $5 billion. Again, this is a change from the initial term sheets that were released by the Fed earlier in April, in which the eligibility requirements were set at 10,000 employees and $2.5 billion in revenue. The borrower must not be ineligible for an SBA loan, although there are some exceptions. The most notable exceptions are gambling businesses and hemp businesses. The borrower must be created or organized in the U.S. or under U.S. law and have significant operations and a majority of its employees in the U.S. And the borrower must not have received specific support pursuant to the CARES Act, but borrowers that have already received PPP loans are permitted. And when you think about what specific support means, the Fed is interpreting that to mean things like the airlines that have received grants directed particularly at companies or industries. The next factor to consider for borrowers is sort of drilling down on the employee and revenue requirements. So for employees, you have to calculate your employees based on a total number of employees, an average of the total number of employees for each pay period during the 12 months prior to origination. Employees include full-time, part-time, seasonal, or other employees, but do not include volunteers or independent contractors. And the borrower has to include its own employees and those of its affiliates. And for those of you that dealt with the PPP program, the affiliate classifications come into play in a very similar way for the Main Street lending programs. On the revenue side, there are two tests, and the borrower gets to choose which tests they'll use in their application. It's either 2019 GAAP revenue on audited financial statements or 2019 receipts reported on a federal tax return. Again, revenues must be aggregated with affiliates. If 2019 data is not available, borrowers are expected to use the most recent audited financials or tax returns. And so, as I mentioned, the affiliate analysis will be important for a number of different kinds of borrowers, similarly to the PPP program. Generally speaking, entities are affiliated if one entity has control or power to control the other, or when a third party controls or has power to control both. The obvious example here is majority ownership, and affiliation will be presumed in that case. But there's also the chance that under the SBA rules, affiliates could be minority investors. So the key consideration here is whether a minority owner has the ability to block certain operational actions, and that's whether as an equity holder of the borrower or through the borrower's board. And then finally, affiliation will be presumed if there's common management. If two companies have the same president or CEO, the rules will assume that those entities are affiliates. I'll speak a little bit more about this later, but particularly when borrowers have taken institutional equity financing, either from venture capital or private equity investors, this has the potential to create some real issues when sort of affiliating with other borrowers or potential borrowers within the investor's portfolio. It's a little bit less of an issue here than it was for Triple P because the number of employees and the revenue thresholds are much higher, but it's still something that should be considered in determining whether these lending facilities are right for a particular borrower. Unlike the Triple P program, there's no industry-specific exclusions from the affiliate analysis. In other words, unlike in Triple P, hospitality businesses or franchised businesses aren't excluded from the affiliation analysis. Like Megan said earlier, one of the biggest pitfalls in this new program is how the loan sizes are determined. Initially, the term sheets put out by the Fed called for EBITDA leverage ratios that were unadjusted. The Fed took to heart the comments that came back from both lenders and borrowers and has now changed leverage ratios to be based on 2019 adjusted EBITDA. The rub there is that the EBITDA adjustments are determined by the lender, and they're based on methodology either previously used by the lender to extend credit to the specific borrower, or the methodology used for similarly situated borrowers. In each case, methodology in effect on or prior to April 24th. So for certain companies, adjustments could mean the difference between being able to participate in the program and not. So it's important to consider what adjustments you'd like to make, and to talk to your borrower about what adjustments they're considering to be permissible. The other pitfall here is that the debt side of the leverage equation is a bit problematic for some borrowers. As you see, that includes existing outstanding and undrawn available debt. There are some exclusions, none of which is particularly material. They include backup lines for commercial paper, receivable lines, lines which require additional collateral to draw more capital, and lines that are for whatever reason no longer available due to a change in circumstance. The point here is that largely commercial debt deals would not count undrawn debt in calculating leverage ratios, but here the Fed has been a little bit more conservative, and so you have to consider both the debt that you've drawn on your books as well as the available debt that you might have under existing facilities. Borrowers have to make a number of certifications, and there's a number of covenants that are mandated as part of the Main Street lending program. Borrowers can't use the proceeds of these loans to repay other loans and can't seek to cancel or reduce any other outstanding credit lines. Lenders will have to certify that there's a reasonable basis to believe that the business has the ability to meet its obligations for the next 90 days and does not intend to file for bankruptcy protection during that period. The business must take commercially reasonable efforts to maintain payroll and its employees. And perhaps most importantly, the CARES Act 1-year post-reclaimment restrictions apply with respect to executive compensation, equity repurchases, and capital distributions. And this is sort of for the period the loan is outstanding and for 12 months thereafter. The Fed did listen to a number of comments and included an exclusion for tax distributions and flow-through entities. So in other words, distributions made to cover owners' tax liabilities are permitted, but other distributions are generally not permitted as far as we can tell. There's obviously unintended consequences here for a handful of very common structures for equity compensation and exits or liquidity events for borrowers. And then particular considerations for companies that have taken institutional equity financing. As I mentioned before, the affiliate analysis will be important, particularly if a company has taken an equity investment from a larger fund, where both the employee size in other portfolio companies and the overall revenue numbers across portfolio companies might cause the borrower to bump up against the thresholds here. For companies that are in growth stages or companies that have taken on private equity financing that might already have fairly sizable debt loads, there's a difficulty with the EBITDA leverage test. In other words, a lot of VC-backed companies won't have positive EBITDA or won't have positive EBITDA to the extent that the loan size would be useful. So it'll be important to consider, in determining whether a borrower would even want to avail itself of these programs. Further to the affiliate analysis, when you're speaking with your investors, there are ways to avoid a determination of affiliation for minority investors, but they involve, your outside investors irrevocably waiving certain rights that might be a little bit difficult to get across, as well as lenders. There's these restrictions on senior debt, and so it's possible that you'll have to speak with your lenders either to take on additional debt or to restructure existing debt to meet the requirements of the Main Street lending programs. On the whole, there's a relatively short maturity period and significant annual payments. Again, for growth companies that would prefer to reinvest any revenue into product and growth, this could be problematic. And then, as opposed to the PPP funding program, where there was essentially an application and a note, and time and transaction costs were minimal, our expectation is that this will be akin to entering into a new commercial facility. It will take some time to negotiate. Both the lender and the borrower have to get counsel involved, and it will generally just be more expensive. And then finally, the restrictions I talked about a little bit earlier with respect to the CARES Act. For certain companies, these could cause problems, particularly when an exit is on the horizon, or you have folks taking compensation in the form of equity. With that, I'll turn it over to my colleague, Ellie Myers, who will be talking about some items that lenders should consider in participating in the Main Street loan programs.
Thanks, Josh. Good afternoon, everyone. My name is Ellie Myers, and along with my colleague, Matt Doring, I'm a member of Nutter's Commercial and Real Estate Finance Practice Group. So as Josh said, we're going to switch gears now and talk through some of the lender considerations relative to the Main Street lending program. So first up, eligible financial institutions who can serve as lenders under the program include institutions like U.S. banks, savings associations, credit unions, U.S. branches of foreign banks, bank holding companies, U.S. intermediate holding companies of foreign banking organizations, really any U.S. subsidiary of any of those institutions listed on this slide. Non-bank financial institutions are not considered eligible lenders under the program. The term sheets for each facility lay out some of the required certifications and lender covenants, some of which mirror the borrower covenants that Josh just covered earlier in the presentation. In each facility, the lender cannot request repayment of debt or payment of interest on outstanding obligations until the loan is repaid in full, unless such payments are mandatory and due. Lenders cannot cancel or reduce any existing committed lines of credit with the borrower. Lenders must certify as to the methodology the lender used to calculate the borrower's adjusted 2019 EBITDA in making a maximum loan determination, as Josh discussed. Finally, lenders must be eligible to participate in the facility under the CARES Act, including in light of things like conflicts of interest. Under each facility, the SPV will purchase a portion of the loan and the eligible lender will retain a portion until maturity or until the SPV sells all of its participation in the loan. So lenders will retain 5% of the loan under the new loan facility, 15% under priority loan facilities, and 5% under the expanded loan facility. The lender and the SPV will share in any losses on the loan on a pari passu basis. The Federal Reserve's frequently asked questions provide some guidance to lenders on whether an eligible borrower is really a suitable borrower from the lender's perspective. And one clear test provides that any existing loan that a borrower had outstanding with a lender as of December 31st of last year must have had an internal risk rating based on the lender's risk rating system that was equivalent to a pass in the Federal Financial Institutions Examination Council supervisory rating system. So that's kind of one test that provides whether the borrower is really suitable here. Other tests of suitability and creditworthiness are largely left up to each lender. Lenders should view the eligibility term sheets as the minimum requirements for the program. And lenders are really expected to conduct an assessment of each potential borrower's financial condition at the time of the borrower's application. Lenders can apply their own underwriting standards in evaluating financial conditions and creditworthiness of a potential borrower. The Federal Reserve makes it clear that lenders may require additional information and documentation beyond what's included in the term sheets. So it's really ultimately up to the lenders to determine whether a borrower is approved for a loan in light of some of these considerations. This means that businesses that otherwise meet the eligible borrower requirements may not actually be approved for a loan or receive the maximum allowable amount from a lender. It's going to be up to the lenders to make those determinations. So what the lender will do is the lender will collect the required certifications and covenants from each borrower at the time of the origination of the loan or at the upsizing of the loan in terms of an expanded loan facility. Lenders can generally rely on a borrower's certification in addition to any other self-reporting made by the borrower to the lender. And the lender is not expected to independently verify the certifications or really actively monitor any ongoing compliance or issues with covenants here. The lender is going to take what the borrower gives to them, make an evaluation and determination based on what's given. A couple points here on existing loans. So an eligible lender that has extended an existing term loan or credit facility to a borrower can increase that extension of credit by adding a new increment. So they can upsize the extension of credit by adding a new tranche here. The underlying loan has to have a remaining maturity of at least 18 months, but lenders can amend their loan documents in advance to comply with this requirement. The lender must retain its interest in the underlying loan until the loan matures, until the upsized tranche matures, or until the SPV sells all of its participation. And finally, any collateral that secures the underlying loan must also secure the upsized tranche on a pro rata basis. A few considerations for multi-lender facilities. If the underlying loan is part of a multi-lender facility, the eligible lender must be one of the lenders that actually holds an interest in the underlying loan as of the date of the upsizing. What's important here is only the eligible lender is required to meet the eligible lender standards that are laid out in the term sheets, and other members of the facility are not required to be eligible lenders as that term is defined. So if there are multiple members in a multi-lender facility, only the eligible lender, capital E, capital L, is required to meet the criteria laid out by the Fed. So those are some of the general considerations that we know, and I'm now going to turn the presentation over to Matt Doring, who's going to talk about some additional unresolved considerations that have yet to be determined.
Well, thank you very much, Ellie. My name is Matt Doring. As Ellie mentioned, I'm a partner in the commercial and real estate practice group here at Nutter. And I'd like to, first of all, thank you all for joining the presentation, especially my lender friends who may be on the webinar today, who are still coming out of the shock that was the PPP program that we went through. And if you think about it, the PPP program was based upon an existing SBA form of note, which some modifications had to be made to, the collection of certain certifications from a borrower. But at the end of the day, it was essentially a non-recourse loan that had the potential to be fully forgiven. As you've heard from my colleagues over the first part of this presentation, the Main Street Lending Program is far from that. And so I believe the title of this program was Main Street Lending, What You Need to Know Now. So for the next couple of minutes, I just want to hit on Main Street Lending, what we don't know yet. And the first and possibly most important piece is what is going to be the degree of interaction and negotiation that each eligible lender has to undergo with the Fed. And by that, I mean, these are all going to be purchased by the Fed, either at the 95% or the 85% level, depending upon the program. And the basis of that participation, which needs to be structured as a true sale, is going to be the participation agreement. Now, at this point in time, the Fed has indicated that a form will be provided, but there is not yet any form to be reviewed and subject to presumably comment as they went through with the initial term sheets. Now that's important, of course, because the basic form of participation agreement will have material terms like voting rights, like when and how remedies might be exercised, and perhaps most importantly, if there's going to be any sort of putback ability if the program terms were not complied with and it came out later. In addition, one might wonder if there's going to be any sort of standardized loan forms for both the new loan facility and the priority loan facility, whereby some sort of standardization might occur for those two types of program loans, which would minimize the review by the Fed and hopefully expedite the process. Though, as Josh notes, these are not a approved on Monday, fund on Wednesday type of program. Clearly, with the upsize program, which are going to be based upon the eligible lender's existing credit documents that are in place, any sort of standardization of loan forms would not be able to be accomplished. However, perhaps there might be some sort of directions or further guidance provided by the Fed as to what types of documentation might be required in order to put the upsizing facilities into place. There is not yet any guidance as to whether or not these forms will actually be published or if whether or not they would be subject to comment. Although, as we know from undergoing the PPP experience, it is evolving, and what is set on day one may be changed by day 2 or day 3, and eligible lenders will need to stay on top of it to make sure that you are indeed working with the latest and greatest regulations. Next up is what level of federal review will there be of the loan documents? And at what point will they be injecting themselves in the negotiation? Are they going to be receiving fully baked loan documents signed by the borrower and the eligible lender and then review it? And then what happens if they need to be modified? Will there be any types of required amendments, which would be a closing condition to the execution and delivery of the participation agreement? Or will they be involved during the negotiation process, which, as you might imagine, would add time and possibly expense at the outset? Apologies, our deck was frozen. An additional item to consider is the type of loan level information that the SPV will receive. And per the frequently asked questions, they will receive certifications, covenants, the lenders, the loan terms, and the loan performance, as well as information on the borrower fundamentals, collateral, and other characteristics. I guess the thing to consider there is, will there be any other additional information that will be required? And more importantly, what will be the timing in terms of the delivery of that information? Again, is it a pre entering into the Fed of the participation, or what will be the monitoring period going forward, quarterly, semi-annually, monthly, that they will want to have, basically an update, a review of this information. And then, of course, what do they do with the information, which hopefully will be addressed under the terms of the participation agreement. So this is interesting. So as you may have noticed with the initial term sheets, it was contemplated that the Main Street Lending Loan Program documents would be based on SOFR. One of the comments that the Fed properly reacted to in issuing the new guidance on April 30th was that the new interest rate would be LIBOR plus 3%, rather than foist upon a change across a whole swath of eligible lenders who weren't ready to have backstops that tied loans to SOFR. We're going to start off with LIBOR plus 3. But as many of you on the phone know, during the course of 2021, LIBOR is expected to go away. And under the guidance of the FAQ, the Fed indicates that there needs to be fallback contract rate language in the loans for the unavailability of LIBOR, which is consistent with the recommendations of the ARRC. Now, the interesting part of that is there is no standardization of language across the industry to be used by eligible lenders. And not all lenders have the same types of language in their loan documents regarding LIBOR unavailability. Without giving any commentary as to the merit of these fallback provisions, we've certainly seen different LIBOR unavailability provisions whereby there would be some degree of lender discretion on what the replacement rate might be, where there would be some sort of discretion as to what the spread might be over the substitute rate. Some documents even have, at this point, a default to the prime rate if LIBOR is unavailable. So without any standardization across the program, when lender becomes unavailable in 2021, there could easily be a situation where the Fed is holding participations in a myriad of loans that are no longer uniform in the rate being charged. One would think there might be some additional guidance coming down the road on that front. So as we saw, and as we continue to see with the PPP, there has been ongoing guidance provided as these various relief programs are implemented. And we do have reason to expect that the Fed will continue to provide updates and guidance on the Main Street Lending Program as it is being implemented. So it is possible and likely that revisions will need to be made in real time. So our recommendation, of course, is that you need to stay vigilant. You need to stay apprised of the updates as they come across, because that is really the only true way to make sure that you are compliant on an ongoing basis. But as with the PPP, and for all the reasons that my colleagues have mentioned, this is not a very simple program to implement. It is not a quick infusion of capital into the economy. But as of right now, the program does expire in terms of when the Fed will no longer be buying participations in these loans as of September 30th, 2020. So that concludes. Yes, thanks, Tom.
Yeah, I think we have some time for questions. I've received a few already. If you don't mind, Matt or Ellie, one of the questions concerns how much eligible lender is expected to actively monitor ongoing compliance of the borrower. And the question really centers around what to do if the lender learns that the borrower has breached a particular covenant.
Tom, I'll take that one. And I think it. So there's two types of covenants involved here, and without sort of knowing what the asker is trying to drive at, obviously there will be likely ongoing financial covenants in the loan document itself. And so a lender will basically follow those as they would with any loan facility in terms of tracking and monitoring that. More likely, I think the question is getting at the various certifications that the borrower makes to the lender as part of the application process, in terms of continuing to employ and using best efforts, going forward on a business basis. And there is no requirement that the lender has to monitor the borrower's ongoing activities to ensure compliance with the certifications that the borrower makes at the outset. However, the FAQ does note that if for some reason a lender does become aware of that circumstance of noncompliance, then the eligible lender has a duty to report that behavior directly to the Federal Reserve Bank of Boston.
Okay, just a follow-up question. Do you think a lender faces some reputational risk if there are substantial breaches of covenants, or if there are misstatements that are made by the borrower? And again, I'm asking you to look at, by analogy, what's occurred with the PPP program.
I think, Tom, that reputational risks are sometimes tough to mitigate against. I'm sure the lenders that extended, PPP loans to, Ruth's Chris and the Los Angeles Lakers, did nothing wrong because they were complying with the terms of the program. There's probably going to be less of a risk here because the banks are asked really to apply their existing underwriting standards, and lenders are not asked to make loans that they would not necessarily have otherwise made, outside of the COVID-19 environment. So I do think that you're not going to be in a situation here where, in part because of the speed of the program, in part because, or lack of speed, I should say, of the Main Street program, in part because of the full underwriting that the lenders are going to undergo with respect to the borrowers, I think that there is less of a chance here for lack of a better word, negative press.
All right. Thank you, Matt. Next question might be best for Megan to respond to. It was mentioned that the interest on these loans is deferred for a year. What actually does that mean? Is this a true deferral, or will the interest accrue during this period? How does it work?
Oh, thanks, Tom. Yeah, that's a great clarification to make. This is not a true deferral, so the interest will accrue and be capitalized. So it'll be added to the balance of the loan, and the interest itself will accrue interest on top. So this should be considered when thinking about what the cost of the loan will be for the borrower.
Right. Thank you, Megan. Another question, and this is similar to the complexity of the PPP program as well. In terms of the certifications and covenants that the borrowers have to make, they use the term commercially reasonable efforts to maintain payroll and employees. What does that actually mean? What constitutes commercially reasonable efforts? Maybe Josh?
Sure, Tom. So, in the FAQs distributed by the Fed, they've said, this means good faith efforts in light of capacity, in light of current economic conditions, and in light of labor needs. So it's a little hard to say with any certainty, and I expect, like a lot of things, the guidance will evolve as the program gets started. The Fed has said that to the extent an eligible borrower has already undertaken a reduction in force, layoffs, or furloughs, they're not disqualified from the Main Street lending program. So the Fed is acknowledging that a lot of borrowers have had to take unfortunate steps already in the last 2 months, and that won't prevent a borrower from applying under this program.
I guess part of this is due to the fact that this program didn't have the 1 week rollout that the Triple P did, and you do have that gap where the only firms had to take immediate action. Maybe the next question should go to Ellie. Are there any fees with the Main Street Lending program, and could you just give us a rough range of what they are?
I think, Tom, yes, there are fees associated with these loans. The lender is required to pay 100 basis points for both the new facility and the priority facility loans, and 75 basis points for expanded loans. Now, the lender can require that these fees be paid by the borrower. And in addition, the lender can charge the borrower up to the same amount for the lender's fee. One other fee that we didn't talk about here is that the SPV can pay the lender an annual servicing fee, and that is 25 basis points. So thanks for the question, Tom.
Thank you, Ellie. Josh, you're our expert on the affiliation rules. This question concerns those rules, and the person's asking for examples of what would constitute an operational action for purposes of affiliation analysis.
Sure, Tom. So, obviously, some of us have been living and breathing this for the last month or so under the Triple P program. And the operational actions prong of the affiliation test really goes to whether affiliation will be found for minority shareholders. And the kinds of things that the SBA has traditionally looked at as indicia of control such that an affiliation determination be made are if your minority investor can control when dividends or distributions are made, if they have a blocking right or any control over personnel decisions, hiring and firing employees, adjusting comp to employees, any approval rights over incurring additional debt or making guarantees of debt, and any rights to control budgeting and expenditure decisions, to sort of draw a comparison to the kinds of actions that traditionally the SBA has not had a problem with. Your minority investors, would continue or may continue to have veto rights over changes of control and the like. So in terms of figuring out whether something is an operational action or otherwise, the SBA takes a pretty conservative view, and most things that might not be considered operational in nature by, for example, a venture capital investor, are actually considered operational for purposes of the SBA analysis.
Thank you, Josh. Another question really goes to whether or not Main Street loans can be secured by a lien, a first or second lien. Maybe Ellie, you could tackle that for us.
Sure. Thanks, Tom. The Main Street new loans can be secured by liens that are junior to liens securing other loans by the lender. And the Fed has come out and said the priority loans and the expanded loan facilities cannot be secured by a second lien. So that's another thing to take into consideration if you're a borrower.
And Ellie, if I could just expand on that a little bit, because it may be a little bit confusing for people that are just picking up the program term sheets and reading it.
Sure.
And the reason why you can have a second lien on the new loan program is that it's clear under the guidance for the priority loan, expand loan facilities that any payment and collateral securing existing loans, the Main Street lending program has to be pari passu or senior to those. whereas the new loan facility says it can't be contractually subordinated. So the difference there is if you just have a new loan facility which is secured with a second lien, there's no contractual subordination there. There is a structural subordination, but there is no separate agreement that is written up which contractually subordinates the payment obligations and the lien obligations for the Main Street loan facility to the eligible lender. So that is why if you're reading it, what that contractual subordination is driving at.
Thank you, Matt and Ellie. This, I think, question, Josh, goes back to something you mentioned briefly in your presentation on some of the certifications and covenants. The question relates to or asks for examples of equity comp and exit structures that could be problematic under the Main Street Lending Program. Would you care to elaborate for us?
Sure. The two most obvious examples are situations that you see fairly frequently. So on the equity comp side, it's not uncommon for employees or executives who are granted equity to have that equity either be subject to vesting or subject to certain buyback rights upon their departure from the company. And it's unclear under the current guidance as to whether that buyback would violate the restrictions on stock repurchases. And on the sort of exit planning, change of control side, remember there's a restriction on distributions to equity holders other than tax distributions and flow-through entities. So if an exit transaction was structured as an asset sale, the only way to get value out to the equity holders is to for the deal consideration to come into the borrower and then be paid out as a dividend or distribution. And as of yet, there's not a carve out that would allow that to happen. Presumably, in that second scenario, you could structure a transaction to prepay the Main Street Lending Program loan just prior to closing the transaction. But it's another step that has to be considered when a company who might have taken one of these loans is thinking about a sale down the road.
Thank you, Josh. This is a fairly specific question on calculating employees and revenue. Are they actual employee numbers or an FTE, full-time equivalent basis? How do you calculate it?
So based on the guidance that's been distributed to date, it seems as though this will be actual humans rather than full-time equivalents. And again, this is a bit of a departure from the triple P world. So it will be, part-time employees still count for one employee.
Okay, that's very helpful. I don't see any other questions. I want to thank the panelists for answering them so completely. Nutter has been producing a variety of webcasts and advisories related to COVID-19 for quite a while now. I just wanted to remind our audience that our next webcast is this Wednesday, May the 6th at 5 p.m. Eastern. This is something that may be of interest to, I think, all of us. The title of the webinar is Moving Forward to the New Normal, Applying Lessons Learned from Around the World to Our Region. Nutter's Paul Ayub will be joined by a panel of global business executives with a wide-ranging and broad number of industries with operations in over 100 countries. They will share insights on how their companies have addressed the easing of COVID-19 restrictions and some of the issues relating to reopening our economy and getting people back to work. Hopefully you'll learn what achieving the new normal may mean, both in the short term and long term. It hopefully will be an important and robust discussion. To obtain more details about this webcast and also to see information on Nutter's latest publications and best practices in this rapidly evolving situation, please visit us at nutter.com or feel free to contact one of our very valuable and talented professionals that were on this panel. So thank you and have a good evening.